So why do I feel like people are getting cautious now? Are you bullish or are you cautious?
Well, I mean, I think it's a great question. It's not a binary. I'm always cautious, and right now I'm cautious in the short term because of the statistic you pointed out that, 95% of stocks in the S&P are above their 200-day moving average. That's only happened like 2 or 3 times going back, 10 years. And so from a short-term technical signal, be cautious. I do think ultimately you have to manage expectations that looking at the S&P 500 or the NASDAQ on rolling 5 and 10-year basis, we are at peak 5 and 10-year returns going back to the S&P since the 30s to the NASDAQ since the 70s. The only other time we had higher 5 and 10-year returns in the NASDAQ was the tech bubble. And so I think investors looking at over the next 5 years should expect lower returns. And also I think that the unintended consequences of the massive monetary and fiscal stimulus, you just can't understand. We can't understand or look around corners to see what those unintended consequences will be. So I'm definitely cautious. I'm going to stay invested. But I think that the easy returns have been made. And we've had a wonderful 5 and 10 years. But I think expect lower returns. The market's telling me that in spades.
All right, Weiss, do you agree with that or not? We're about to have, here's what I don't get, okay? We're about to have the greatest economic boom, arguably, of all of our lifetimes, right? That's what the forecast looks like. And yet I feel like people are now getting more cautious. Does that mean that all of that good feeling is already in the market? Is that really possible?
Well, to Bryn's point, which I agree with, is that the easy return's been made. Now it gets a little tougher. So what I'm seeing in the market, and I have pared back my exposure, I would say across the board, but through a large swath of the portfolio, there's a flight to quality. So the stocks where you're making promises for not just tomorrow, but out 10 years, 15 years, they're going to continue to be under pressure. In terms of the boom that you're referencing, I think you want to be in some of those stocks, not all of them. Some are still undervalued. So there's some upside. But I don't know if this is occasioned, frankly, by work reopening, in other words, going back to the office, the hobbyists who gotten late now not taking losses and so just selling because they've been petering out, or if it's, people worried about where rates are going to go. My view is that, as I said, go to quality, but that the market's going to get to the place it needs to be in terms of rates way before the Fed gets there. And that the Fed's got to start pulling back at some point. We've seen the inflation numbers. It'll be a key moment in the market early in May when we get both inflation and payroll. So if you see another 1 million jobs or close to it, then I think you see the 10-year continue to move up in terms of the yield. And I think we've seen the bottom. So, yes, so I'm more cautious, but I do believe you could be bullish. I've got more cash than I've had. I don't know if I'm going to deploy at any point soon, but it's a question of where you are in the market, not if you're in the market.
So, Joe, you sold Pinterest, and you make the call that it's not the time to be in high valuation stocks. You have been coming around to the idea that technology was due for a bounce, which it is leading in the month. But do you draw the line that you just cannot own these high valuation stocks like a Pinterest and some of the other well-known brand names that we've been talking about for so many months now?
The S&P 500 is currently 16% above its 200-day moving average. Generally, when the S&P is between 15 and 20% above that 200-day moving average, you tend to have a problem further advancing. So I look at everything from the perspective of not how much money can I make, but how much money potentially can I lose. The market gave me, in the first 3.5 months, 11.5% for the S&P. All I am doing, to Stephen's point, it's not about being in the market. I'm in the market. I generally put on 29 stocks. Right now I have 28 stocks in my portfolio. But I'm just looking at the characteristics, Scott, of the stocks that I own. And I've been on this show advocating for Pinterest. I've been highlighting the 50% annual sales growth over the last 3 years. 250% EPS growth in the last quarter. But guess what? When a stock goes down 11% for no identifiable reason, and when it declines another 4% beyond that, I don't have the right anymore to extrapolate this fundamental confidence. I have to focus on risk management. And I think stocks that are triple-digit valuated, okay? I think those stocks right now, given the dynamics of the market, I think that's where you really have to be prudent, have to be very discerning. I don't think you could expect another 11.5% over the next 3.5 months. You're going to be in the market, but I think you want to focus a little bit more on quality. And I also want to see if we get a further unwind in cryptocurrencies, what type of impact that's going to have on these higher valuation stocks. And I think you and I would agree, not a good one.